Hello and welcome to today's seminar. My name is Angela. I'll be your moderator for today's web event. Before we begin, just a few housekeeping items. We'll be answering questions at the end of the presentation today. We encourage you to type and submit your questions during the presentation. To do so, click on the Q&A tab, the bottom left of your webinar window. Click the submit button to send in your question. To download a copy of today's presentation, navigate to the materials tab. And if you need assistance at any time, click on the help tab for our support team's contact information. Great, I think we're ready to begin. Today's NCACPA web event is titled 1031 Tax-Free Exchanges versus Opportunity Zone Investing. Now it's my pleasure to introduce our speakers for today, Dax Dixon and Dennis Stearns. Dax and Dennis, the floor is all yours.
Thank you very much. Welcome, everyone. This 1031 versus Opportunity Zone investment topic is one that we have been involved with for some time now. And historically, we've done, as I'm sure many of the folks in the audience have done, many 1031s, and never quite understood why it was tax-free, because it's really tax-deferred exchange. And so now the 1031s are under a little bit of scrutiny and potential new tax laws, and we have this newer opportunity zone. I thought it would be fun to look at the pros and cons of 1031s versus opportunity zones. I am joined today by Dax Dixon, CFA, Chartered Financial Analyst, and Dax is looking at a lot of these same issues around economics versus taxes, and we're going to delve into a few case studies today. Again, we have a couple of things that will help us understand what your particular clientele level is, because some of the things we're going to talk about today will definitely depend on whether we're talking about somebody under or above a certain income level, at least based on what may be upcoming tax legislation. With that, let's dig in. So, opportunity zones, again, we're assuming a certain base level of knowledge in the audience today. I think our person, the CPA who actually went through all the material, rated this an intermediate session. Parts of this may be a bit above intermediate, but the baseline on opportunity zones, they were created effectively in 2018, and it was a bipartisan creation of the zones themselves. There was a lot of wrangling that was done at local, communities, regional, state levels to determine which were going to be the opportunity zones. And they are all over the United States. Again, we have the breakdown here between rural, 40%, urban, 38%, and suburban, 22%. But that really doesn't tell the whole story. We have worked with developers, CPAs, a variety of people that are looking at individual opportunity zone parcels. And the conclusion we have come to is the vast majority, whether they're in North Carolina or around the country, are not ideal economic opportunities. And so one of the things that we have been encouraging our clients is to be very careful. And when these first came out, there was a lot of discussion about this being sort of the 1980s tax shelter. And so a number of family offices we work with, they were very concerned about letting the tax tail wag the dog. Now, we are going to be talking about a lot of tax issues today. So there certainly is a lot of that opportunity in the opportunity zone. But again, I think our basic comments around opportunity zones and 1031s for that matter is that economics should continue to rule the day. So Dax, let's go to the next one. So again, base level of knowledge on 1031s we are assuming in the audience. And so as of January 1st, 2018, on 1031s, only real property held for production of income in trade or business, regardless of location, is eligible for the deferral of taxes. Opportunity zones, on the other hand, any property that generates capital gain upon sale, including stocks and real property. Many of the ones that we are working with today are gains from either stocks or real estate. In some cases, sale of a closely held business. We have a number of those that are either in process or completed, and those are also eligible for opportunity zones, whereas maybe less eligibility under the 1031. So here, the wider range of property eligible for gain deferral gives the nod to an opportunity zone. The types of property eligible for reinvestment, again, on the 1031, we have this like-kind criteria. And that like-kind criteria has been very broadly interpreted in many cases. In opportunity zones, again, there's no like-kind requirement. And so the question here is property eligible for reinvestment. Can you, with an opportunity zone, even look at a business investment as opposed to a real estate investment? And we have reviewed a number of those where businesses were being qualified to be located in an opportunity zone. Now, the issue that has come up with a number of the CPAs and tax attorneys we work with is, how do you stay qualified for the 10-year period for an opportunity zone? And that's a tough one for businesses. And so if they're doing business all around the country, if they have satellite operations, people in other states, if they're not located in an opportunity zone, what would disqualify you? A little beyond the scope of what we're doing today, but again, it's a question that we get frequently is, could I make a business qualify? And the answer is yes, but with a lot of caveats and good professional advice. Next slide. And so here, there are advantages to both the 1031 and the opportunity zone. Again, geographic flexibility on the 1031. It's not restricted to distressed areas. And it can be existing property without substantial improvements. And that is one of the things that's important in the opportunity zone, is there have to be substantial improvements to make it qualify. Next slide. Reinvestment timing. This has been an issue for a long time with 1031s, is that you have to identify the replacement property relatively fast, and you have to close on that replacement property within 180 days. Now, many years ago, this was not a particularly big issue because we had a lot of things to choose from that were reasonably priced from an economics viewpoint. And today it's more challenging. And so some of the 1031s that we've been working on, we may have to go through 20 or 30 properties to find the one that we really want at the right price. And so it's a little bit more challenging on that. Opportunity zones, again, you have to invest in the opportunity zone within 180 days, and then additional time to invest those funds into an actual property. One of the things that, again, everyone is probably aware of on this call is that if you're an LLC or other entity, with the closing of the fiscal year, you have 180 days from that date to reinvest. And so advantages here, both 1031 and opportunity zone. The 1031, you can identify and acquire prior to the sale of the existing property. So that effectively extends the date, assuming that that you aren't completely wrapped up in the sale of property relative to a business. We see that frequently, that things don't start happening until the actual sale. In the opportunity zone, again, it eliminates that intermediate step of identifying the replacement property. Next slide. Required amount of reinvestment. This is where you divert fairly significantly. The 1031, the entire proceeds from sale, including the proceeds used to repay debt, are required to be reinvested to achieve 100% tax deferral. Whereas in opportunity zones, it's only the capital gain that needs to be reinvested. We have one situation we're working on. It's a California client looking to do a 1031 in Arizona. And this particular situation, the client is actually thinking about not reinvesting 100% in the Arizona property, triggering some gain, and then doing an opportunity zone on top of the 1031. So actually a dual strategy, which worked out very well from the client's perspective. Next slide. Access to proceeds, again, this is one that most of the time we don't see being a big issue, but occasionally is a problem. And you have to have the qualified intermediary. Again, we're assuming that most of you have worked with qualified intermediaries. Most of them are reasonably good and do a good job in terms of the efficiency of the process. But essentially, you don't have access to those monies while they're in the hands of a qualified intermediary. The proceeds from the initial sale in an opportunity zone are not directly traced. So you don't have to have the intermediary, and it can be other monies that are invested in the opportunity zone to create the opportunity to defer and then have tax-free growth. So again, there are the advantages to the opportunity zone. Again, we would probably not put this on the top 3 list for most situations, but occasionally it does become an issue. Next slide. So let's see, did we skip a slide?
I double clicked, so I had to check.
Okay, got it. Yeah. Yep, thanks, Dax. So the timing of deferred gain recognition. Again, this is a one of those situations where the 1031 is, at least in our mind, a clear advantage. And so when the replacement property is sold, unless another like-kind exchange is used or the gain is invested in a qualified opportunity zone, you basically have the ability to figure out when to time the sale. And for our clients who have done multiple 1031s, this becomes a key issue. And again, depending on what new tax legislation may come along, this could become an even more key issue. The opportunity zone is much more restrictive. So the deferred gain recognized at the earlier of sale of the qualified opportunity property or fund, or December 31st, 2026. And again, most opportunity zones we see are going to at least go to that 2026 date, if not the full 10-year period of time, in order to get tax-free returns on the property. And so, again, I think when we get into cost basis issues, this is another area that 1031s still may be viable, or a combination of 1031s and opportunity zones. Okay, next slide, Dax. And so the exclusion of gain via a basis step up, the 1031, at least under current law, has the advantage of being stepped up at death. And again, we note that could be eliminated in some proposed tax law changes. The interesting piece here, the old strategy, which in the white paper that we included, that hopefully most of you got in signing up for this, had the defer, die strategy. Not that we actually suggest death as a strategy for clients, but that has been used by a lot of our clients. They defer the gain once, maybe they defer the gain twice. Occasionally, they even defer the gain 3 times, and then they die with the property, get a stepped up basis, wipe out a lot of the gain. Again, opportunity zones have a very convoluted calculation in terms of the step up. So it is not a full step up under current law. And if the step up in basis does get changed either across the board or for certain income categories, that could actually swing the advantage back to the opportunity zone. But at least today, the ability to defer, die probably favors the 1031. Next slide. And again, I think the one nuance here, there are many nuances, but the one nuance is at least this year, the opportunity zone, you can permanently eliminate up to 10% of the initial capital gain. And so if you think in 2026, your capital gains rate will be 10% higher, effectively, you have a 10% higher tax, but 10% forgiven. If you're talking about a very high net worth or high income, and again, income may be the key under proposed tax law changes at either $400,000 of taxable income or $1 million of taxable income, you could be in maybe a 20% higher rate in 2026. And then you actually have a reverse deferral where you are paying a higher tax in 2026, even with that 10% forgiven. And again, that 10% forgiven under the original legislation, it actually started out higher. Now you need 5 years through the 2026 date to be able to get the 10%. That effectively goes away January 1st, 2022. So January 1st, 2022, we do not get the elimination of that 10%. Now, as we'll talk about a little later, there's an awful lot of focus on the deferral, which is helpful, but it's actually the tax-free future returns that are a bigger economic benefit for a number of folks. And so whether you have the 10% or not may or may not be relevant to a particular fact pattern. Next, let's go to the next one. State and local taxes. Again, many of you are probably aware that on 1031s, vast majority of states conform to the tax treatment. There are some states, including an adjoining state to us, that do not conform. And so when you have a situation where you don't have some of the conforming regulations in place, you do have to try to be thinking about what's the impact of those state or local taxes. Again, for many states, that's not a huge issue. California and some of the states with higher income taxes certainly is. Opportunity zones, again, some states are approved and conforming for opportunity zones. Note that North Carolina is non-conforming. California is non-conforming, and California has a pretty high state income tax. Now, there's been discussions in the state legislature in California that have been ongoing about becoming conforming. Most of the folks we tie into think it's possible, but it still hasn't happened. And so, again, I think this is where the state and local tax piece, maybe it doesn't fall into the top 3 of the analysis, but it does need to be looked at. Next slide. Related party transactions, again, occasionally becomes an issue. And the 1031, you do have, you can acquire replacement property from a related party, but it triggers a 2-year holding period requirement. Now, again, for many of our clients, that's not an issue because they're planning on holding it for at least 2 years. And that's part of what they've deferred for. And you can sell a property to a related party without holding period requirement under 1031. Opportunity zones, there is no deferral on gain from sales to a related party. And there are restrictions from related parties with 20% common ownership. So again, this particular one, we give the nod to 1031. Expiration, at least right now, there is no expiration on 1031. Again, a lot of discussion going on about possible personal tax law changes for 1031, and it appears those would be for folks making more than $400,000 per year or gains above $500,000. Again, there's been discussions on both fronts. We'll have to wait to see on that one. Opportunity zone is pretty much set in stone. December 31st, 2026 is when the deferral will be ending for any gains deferred today. Next slide. So, Dax, you want to walk us through our case study?
Absolutely, Dennis. I think you did a great job kind of reviewing the advantages and disadvantages of each of both the 1031 as well as the opportunity zone investing. And so I think to borrow from your vernacular, one size fits one. So we did a case study here, but obviously when we're working with clients, we want to consider the underlying economics of the investment as well as the underlying tax pattern of the client. So in this case study, we're looking at a property that's sold for $500,000 and the cost basis is $250,000. And because of the rules of the 1031, all that $500,000 has to be reinvested in a qualifying property. And in this case, we're looking at a property that generates 6% annual income and 5% annual appreciation over a 10-year time frame. So at the end of that 10-year time frame, and we have about $1.4 million in the investment, and if at the current 20% capital gains rate, that means the net value before state taxes are taken out is about $1.146 million, and if tax rates increase, it'll be about $872,000 net from this particular investment.
Yeah, and so again, this is the situation where we do not defer, die. We defer, and sell. And again, I think the vast majority of our 1031s don't intend to sell within a certain period of time, but deteriorating real estate conditions in a particular area, local or regional, have caused some of our clients to want to sell sooner. We also, for this purpose, have not included the NIT, and later on we bring that back into the equation. But here we're just trying to do apples to apples to an opportunity zone, which I believe is the next slide.
Indeed. And so here, as opposed to the 1031, you don't have to invest the entire proceeds of any gain or any property that's sold that you do realize a gain on. So in this case, the property is sold for $500,000 and the cost basis is $250,000. And so you do have $250,000 in gains that needs to be reinvested in a qualifying property, and another $250,000 that we're assuming is reinvested in a different type of asset that's generating 10% over the lifetime of this investment. Within the qualified opportunity zone, we assumed that you have 5% annual income and 2.5 annual appreciation over a 10-year time frame. So at the end of the 10-year period within the opportunity zone fund, your gross value is $1.163 million. The net value with a 20% capital gains rate is $1.0515 million, and the net value, if we assume a 40% capital gains rate, is about $866,000.
So what you end up with is, again, depending on the tax bracket of the client, you end up with reasonably similar numbers, even though we're assuming here a lower annual appreciation on the Oz. And it is interesting, this for this particular case study, we had the refinancing before 2026, and some of the entities that we work with are planning to do that to help pay the deferred tax. And again, that's extremely helpful, except for our clients in extremely high state income tax situations where they have to pay again the tax now and then a deferred tax later. So sometimes the refinancing won't cover all the deferred tax. But again, as you can imagine, it helps the rate of return over time if the property itself can help pay the deferred tax. So the 1031 versus opportunity zone, again, in this particular situation, we consider it still valuable as long as the returns of a single property well exceeds the returns of a diversified Oz fund. And that one is one that we think is more problematic today. Again, it's just because of the fact that there's so many places that we work in around the country and in North Carolina where the economics of certain properties have become more stretched. And so finding that right property can be more difficult, and or you're, finding a property that nothing against Pancake House, but might be an IHOP or or something where you don't want to take necessarily the tenant risk. And so the diversified Oz fund, you don't have to have the same rate of return to get a good risk-adjusted return. The 1031 really does have to have better return dynamics going forward in this environment. And again, this third bullet, if the returns are equal in 1031 versus the Oz, plus whatever else you invest in other than Oz, because remember in our example, we only had to invest the actual gain. We had the other amount that we could invest in other real estate properties starting from zero with depreciation. We could invest in stocks. We could invest in another business, a variety of other things. So if the returns are equal, then Oz does come out ahead for higher tax bracket investors. And again, this is where tax-free is, at the risk of sounding very basic, is generally better than tax-deferred. And so one of the things that, again, is a conundrum for all of us on this call is the last bullet. Tax law changes have been more the norm lately, and so any analysis can be changed if rates change again in the next 10 years. And if we have various political parties coming in and out of power, could there be even more than one change in addition to whatever change is happening this year? Yes, it's possible. How much will that impact the majority of people we work with? Maybe not huge, but certainly for those clients who do have the much higher income, again, probably over $1 million of taxable income, there could be some material differences. And so that's where I think doing some scenario analysis around these case studies is very helpful in today's high fog environment. So Dax, lead us through some of the investment considerations.
Yeah. And so I think, obviously the underlying economics of any investment, regardless of the tax treatment, need to be evaluated. And so on the 1031 side, it's just standard evaluation of property location and potential returns, weighing those against the risk of that location. And it limits your diversification. So most 1031s are single property to single property. On the flip side, opportunity zone funds, again, standard evaluation of single property, or even diversified fund managers and their track records, whether that's within an opportunity zone fund or even if they run a non-opportunity zone fund. You want to make sure that that manager has some experience in these types of locations where opportunity zones are located. Higher underwriting standards because you have a longer hold period, potentially a refinancing of the properties before taxes are due in 2026. And finally, many OZ funds have lower leverage than some of the single properties. So apples to apples risk needs to be evaluated if that is the case.
Yes. And, I think, again, one of the things that we have seen is that some of our older clients had more tolerance for single property risk, perhaps when they were younger. And in some cases, they are having less tolerance for single property risk as they get older. And so that's yet another consideration.
Absolutely.
So can a property with debt be exchanged under 1031 for a property with no debt? If you had a mortgage on the old property, you have to have a mortgage on the new property as well for the same amount or more. Now, again, that's to make the deferral be full in the 1031. And as I mentioned earlier, our California client looking at the Arizona property is actually looking to not have the same amount of debt and actually reinvest less in the property to trigger some gain in order to use both the 1031 and the opportunity zone at the same time. Another frequently asked question, are opportunity zones mostly in distressed neighborhoods? I will say that we have seen a number that definitely were distressed. Most of those hit the circular file. But many are in areas that are being gentrified, and so they have positive trends. And again, I think most of the professionals that we work with around the country, they actually believe that less than 10% of Oz's opportunity zones are high enough quality for tenant satisfaction and long-term appreciation. Now, they're doing a risk mitigation analysis on that. So what that means is they are trying to understand the trends of a particular city and understand what the trend might be for a particular area. They're talking with city councils, developers, all kinds of people just to try to understand, could we be in trouble locking this up for 10 years? And again, those are the kinds of managers, those are the kinds of questions we want asked in any part of the country where we're considering an opportunity zone. And then another frequently asked question, can we use a 1031 exchange to build a rental house? And build, again, this is maybe become a little more popular even with high lumber costs and difficulties getting contractors. But this has become a little bit more of an interest because of some of the valuations of properties in a certain price range that have just skyrocketed during the pandemic. And so built-to-suit exchanges do allow the replacement property in a 1031 exchange to be renovated or newly constructed. And these are subject to the 180-day time rule, meaning all improvements and construction must be finished by the time the transaction is complete. I know at least one of the professionals who is on this call had that issue with a client trying to do this where they just couldn't get the work done with the contractor shortage. And so, again, in normal times, this is probably not as big an issue, certainly a bigger issue today. Hopefully we are moving towards normal times in the next few years. Don't know. All right, Dax, lead us through opportunity zones and the three potential benefits.
Yeah, so this is an infographic that kind of explains and walks through the benefits of the Opportunity Zone Fund. The first one is just the deferral of recognition. So you can defer until December 31st, 2026 if you invest in an Opportunity Zone Fund. So obviously you get that compounding effect of the money over that time. However, as Dennis mentioned, this might be one of the three potential benefits that goes away at the end of this year. So starting January 1st, 2022, this benefit may no longer exist. The second benefit is just the reduction of the taxes owed. And so you do get a 10% reduction on whatever the gain may be, but that might not be as big a benefit if tax rates go up and you end up paying more, but on a lesser amount of gain. And then finally, at the completion of the project or the Qualified Opportunity Zone Fund, you get to recognize all gain tax-free. So I think that, as Dennis, you mentioned, that's probably the biggest benefit that we're seeing is if you can compound over 10 years and then receive all of that compounding back to you tax-free. That's certainly a big benefit for a lot of the scenarios that we look at.
Yeah, one of the big advantages of real estate over time has been the conversion of ordinary income to capital gains. And that happens as the cost basis is being reduced by depreciation. And again, I think many of the folks we work with in the Opportunity Zone area are thinking that the income reducing the depreciation will essentially be converted to tax-free, not to capital gains, but the income actually converted to tax-free as the deductions reduce the basis, and then the basis is completely adjusted in 10 years. So we have some situations, depending on the property, where it's not 100% converted in 10 years, but most of the ones we've seen have been close to 100%, maybe they're 90 or 95%. Yeah, so go ahead, Dax.
Okay. So this is a poll question that we have here. Just, wanted to elicit some feedback from the audience on in your opinion, do you believe long-term capital gains rates for your clients with taxable income under $400,000 will in the next 10 years, A, rise over 20%, B, rise over 10%, rise more moderately, stay the same, or go lower? And then as a follow-up to that, we have a second poll question. So do you believe long-term capital gains rates for your clients with taxable income over $400,000 will in the next 10 years rise over 20%, rise over 10%, rise more moderately, stay the same, or go lower?
So we are getting some results back, and it's kind of interesting. So taxable income under 400,000, 25% of those who responded believe it'll rise by over 20%. 25% believe it'll rise over 10%. 42% believe it'll rise more moderately, and 8% stay the same. Now, the over $400,000 predictably is higher, and so the rise by over 20% is actually the same number, 25%. The rise by over 10% is much higher, 58%. So again, majority of you believe those clients with over 400,000 in taxable income, whether it's today's tax changes or somewhere down the road, they're going to be looking at longer by over 10% increase in long-term capital gains rate. Actually 0 said stay the same or go lower, and 17% said rise more moderately. So again, pretty clear what everyone here believes, and we would concur. Who is in the crosshairs of some of the increases in taxes in the future.
Yeah. And so that's why when we're looking at qualified opportunity zone investing, that we wanted to model out, the potential impact of tax rate changes over the investment lifetime of any qualified opportunity zone fund that a client may invest in 2021 in this case. And so the assumptions that are kind of baked in to this table are down below, including this is a North Carolina scenario, so we do include state income tax as well as the net investment income tax within this analysis. And so you have two sets of columns. So the far two left columns are comparing a taxable investment to a qualified opportunity zone investment over a 10-year period, with both having a 7.5% rate of return. And so you can see there the post-tax proceeds comparison under current tax rates, given the same rate of return, you'll have about $221,000 more after tax within the qualified opportunity zone investing. That benefit does decrease as we go over to the far two right columns and compare under a new tax regime of 40%. And so there you're seeing a potential tax benefit of $206,000. So not as much, but we're still seeing in this scenario, given given all the assumptions, that the clients are still probably a little better off on an after-tax basis in the qualified opportunity zone fund versus a more traditional investment, whether that's in real estate or another asset class.
Yeah, and I think one of the key discussion points here is this concept that, again, the deferral is perhaps valuable and nice, and if the qualified opportunity zone refinances the property and pays back some or all of the money for taxes before 2026, the client is going to be pretty happy with that result, because they didn't have to invest some much lower amount after tax today. But the real key is that growth for the future and how well will the property do. So many of the qualified opportunity zones we've been looking at, multifamily, again, there are some areas that are qualified opportunity zones that you might not guess are qualified opportunity zones. And so there have been interesting properties in Nashville, New Rochelle, New York, of all places. For those of you who know New Rochelle, many people don't even think they have an opportunity zone there, but they actually do. And so, in the industrial area, we're seeing a lot of development in industrial. And when we say industrial, we're not talking old industrial of oil tanks. We're talking about new industrial of supply chain distribution centers for high-tech hubs. Austin would be an example. Areas that are close, Amazon, but areas that are close to the supply chain for Amazon and other companies. And so, again, I think this is one where the growth prospects for most of the Oz properties we're looking at, they're not as high as some of the just regular real estate that we're investing in on the private side. Certainly not as high as the REIT public side of investing. But that tax-free piece is really what kind of tips the scales over. And particularly for somebody, if they're going to pay their tax and reinvest in something, and even if they're in the very highest tax bracket now and for the next 10 years, whatever they reinvest in is going to be subject to that higher tax rate too. And that's the piece that often gets lost in this calculation, either looking at opportunity zones on their own or the comparison of 1031 versus opportunity zones.
Yeah. And so this analysis that we're looking at here just shows, if we do assume a little bit higher rate of return than 7.5%, here we're assuming 10%. Just that 2.5% extra does equate to more after-tax proceeds to the client, both under the current tax regime, if that's going to continue to the future, or under a new tax regime that's higher. And if we get a tax regime somewhere in the middle, as many of our attendees have expressed, that it's probably not going to be double the tax rate, but somewhere between, a moderate raise to a 10% raise on those higher brackets. The analysis will be in the middle here of these two numbers.
So one of the pieces that qualified opportunity zones, as in terms of a portfolio asset, you need to look at, we have safety protocols in terms of how much we have in liquid, semi-liquid, or illiquid. And the question is, how much is too much in a qualified opportunity zone? And many of you may be like us. We have some clients who real estate's their thing, and they've got 75% of their assets in private real estate, either things that we have sourced or properties they have sourced, or sometimes a combination of both. And so the question really is, how much will be drawn down during life? And 10 years is a long time as a horizon, but if it only represents 5 or 10% of your portfolio, that is something you can diversify with other types of asset classes. If instead, we have one North Carolina client, did very well, sold his business interest for a very large amount of money, and was contemplating putting the majority of it in an opportunity zone. And it made us a little nervous to put that much in one area. Now, we went through a lot of different scenarios. We ended up with, I think, a good balance. But again, that's the question is okay, opportunity zones are pretty interesting, but how much is too much?
And the final thing we wanted to discuss is just different state tax regimes. I know, Dennis, you mentioned that there's some states that are non-conforming, and then there's other states that just have higher taxes. So we wanted to model out how that would impact the comparative return of a qualified opportunity zone fund versus a non-opportunity zone investment. And so, if we kind of look at both the current 30%, or if we look at a 30% federal tax rate versus a 40% federal tax rate, we can look at the kind of the after-tax equivalent return. And you can see in most cases, and in all cases here, regardless of the tax regime, if we assume a 7.5% return, a non-equavalent or a non-opportunity zone fund equivalent, you'd have to have a much higher return to equate the after-tax return of 7.5%. So I think that, to your point, you still want to maintain diversity within your portfolio. But, if you look across the regimes, there's definitely some compelling return scenarios after tax that we're seeing out there.
All right. Next slide.
Well, I think we have our question slide with our disclosure. So if anybody has a question out there, or Dennis, if you have any parting thoughts.
Well, our group has been very good at holding their questions till the end. I don't actually see anything in the Q&A right now. We have talked about a lot of the frequently asked questions we actually get throughout the course of this.
Well, I have a quick question for you, Dennis.
Okay, go ahead.
I know that you mentioned that some of the fund managers that we work with say that less than 10% of qualified designated opportunity zones are in areas where they see positive trends. Do you see any changes on the horizon that may reduce or increase that amount, or reduce and increase the opportunity for investment within these areas?
Well, it's a good question. There has been discussion in Congress about having another level of opportunity zone that is more in the extremely difficult area of a city, but it doesn't even have to be a city, that needs to be developed, and creating additional tax incentives, because the natural thing that has happened is that the areas that perhaps need the development the most are not getting the majority of the Opportunity Zone money. So I would say that our thought process there, we have been involved with a few properties that had more issues, and we did make significantly higher returns on those, but they were very special situations. And again, we would consider those to probably be higher risk. And given all the wrangling that's going on in Congress right now, we have a very low confidence level that there will even be a second level of Oz tax benefits available. It's possible, but again, I think what I'm trying to say is, if we do get a second level, that is really buyer beware. Now you're really needing to make sure that first piece, that when we look at something, it's who are the people involved. And if we're not 100% confident in the skills of the manager, we take a pass. And I say that because early on in the Oz, as we were looking at dozens of different opportunities, many of the Opportunity Zone managers were new to working in those particular regions. And so they were newbies. They didn't necessarily understand the dynamics of the marketplace. Our preference has been the folks who are not newbies, who have been working in these areas, whether it's industrial or multifamily or other areas of real estate, for some time. And so they already understand the unique dynamics of an Opportunity Zone.
So I think I have time for one last question for you, Dennis. You talked a little bit about single property risk within 1031s. And so that kind of leads me to ask the question of, we've definitely seen some trends accelerate because of COVID, such as working at home and maybe some migration out of certain cities. How do you see that impacting, whether it's the 1031 space or the Opportunity Zone space moving forward, if those trends stay intact?
Well, and that's a very good question, and particularly the office market seems to be the bigger issue there. The millennials, there's such a large group of millennials, and now the Gen Z coming along, that love to have apartments, and a very high percentage of those categories, they don't even see themselves owning a home as the American dream. So the trends in many of the apartment areas are still pretty good. In most areas we're looking at, there's a few areas where we think there may be some overbuilding going on, but the trends are pretty darn good. The office area is one that we definitely have more concern about. And we don't see that many 1031s, and we actually don't see very many Opportunity Zones at all doing office. But with that said, the trends that we see in office, it generally is the A grade tenants that are going to be more stable. And so the B and C grade tenants have been very unstable in the pandemic. And we just got some interesting statistics last week. One of our large entities that we work with in real estate all over the country, they interviewed in office the CEOs of companies that are tenants in their properties all over the country. And 6 months ago, 40% of those CEOs said they would be downsizing space as a result of working at home virtually, et cetera. Today, that number is 10%. And now the nuance here, though, is that many of those CEOs say that they're looking for more virtual employees in the future. So as they grow their business over the next 5 or 10 years, maybe they're not going to do as much office space, and they're going to have more people working virtually. So again, that's the trend that a lot of people are trying to figure out how to avoid the negative side of that trend. We've only seen a few 1031s lately that even involved office space. So,
yeah, so a lot of movement there. I think we're butting up against our time here, Dennis. I just wanted to thank each of our audience members for joining us today. And if you do have some questions offline, I believe that we can send out our information so you can email myself or Dennis.
As usual, we hope, because we attend a lot of these continuing ed sessions ourselves, we hope you got at least one or two nuggets that might have been an aha moment for you. And again, thank you all for attending.
Thank you, Dax and Dennis, for sharing your expertise. And thank you all also to our participants for joining us. This concludes today's presentation. To submit for credit, please click on the Credit Submissions tab. Once finished, you may simply exit out of the browser window. We hope you have a great afternoon.